taking positions in futures contracts.
What does taking a position mean?
In the cash or spot markets, one buys and sells stocks and commodities. One can buy and sell futures contracts in the derivatives markets as well. However, in the futures markets, one often hears about the terms going long and going short. Buying or selling a futures contract is also called taking a position. A position in an individual futures contract is either a long position or short position. In the next few videos, we will look into long and short positions in greater detail. Now, let us understand two of the most important concepts in futures trading: going long and going short. We will use a real market example, the MCX crude oil March 2026 futures contract. This is a futures contract on crude oil traded on MCX. One contract represents 100 barrels of crude oil. The price is quoted in rupees per barrel. So when you see a crude oil futures price on MCX, that price is the price for 1 barrel, but your actual contract exposure is for 100 barrels.
What is going long and going short? Can you explain with an example?
As we have defined before, a futures contract is simply an agreement traded on an exchange to profit or lose based on how the price of the underlying asset moves. In this case, the underlying asset is crude oil, and there are two participants in the contract. One is long and one is short. Let's come to the two sides of a futures contract, going long and going short. 1. Going long. Going long means you buy the futures contract first because you believe the price will go up. Suppose MCX crude oil March 2026 futures are trading at rupees 6,500 per barrel. You say, I think crude oil prices will rise. So you buy one futures contract. You have taken a position, which in this case is a long position. Remember, one contract is 100 barrels. So your position value is rupees 6,500 into 100 equal to rupees 6,50,000. Now, suppose after some time, the futures price rises to rupees 6,800 per barrel. Your gain per barrel is rupees 6,800 minus rupees 6,500 equal to rupees 300. Since the contract is for 100 barrels, your total profit is rupees 300 into 100 equal to rupees 30,000. So, when you go long, you profit if price rises, you lose if price falls. 2. Going short.
What is going short then?
This is the part that confuses most people. Going short means you sell the futures contract first because you believe the price will fall.
What is going short then? How can I sell something I don't own?
That is a very good question. In the cash market, this would indeed sound strange. If I want to sell a phone or a gold coin in the normal market, I usually need to own it first. But a futures market is different. In futures, you are not selling a physical drum of crude oil sitting in your garage. You are entering into an exchange-traded contract whose value moves with crude oil prices. The exchange allows one person to take the buy side and another person to take the sell side. That is how the market is created. So, in futures, selling first is completely normal.
Can you explain this with an example?
Let's take the same example. Suppose crude oil March 2026 futures are trading at rupees 6,500 per barrel. You think the crude oil prices will fall. So, you sell one futures contract at rupees 6,500. You have taken a position. In this case, it is a short position. Notice carefully, you have not bought first, you have sold first. This is called going short. Now suppose later the price falls to rupees 6,200 per barrel. Since you had sold at rupees 6,500 and the price is now rupees 6,200, you can close your position by buying back at the lower price. Your profit per barrel is rupees 6,500 minus rupees 6,200 equal to rupees 300. For 100 barrels, your profit is rupees 300 into 100 equal to rupees 30,000. So, when you go short, you profit if price falls, you lose if price rises.
Can you please clarify again?
Yes, let's clarify again. In futures, shorting does not mean stealing or borrowing oil. It means you enter the market on the sell side first. Then you close the position by buying. So the sequence is short trade equals sell first and buy later. In some types of contracts like gold, you can choose to deliver your short position. Whereas a long trade is long trade equals buy first and sell later. Again, in some types of contracts like gold, you can choose to take delivery of your long position. However, from a trading point of view, in both cases, what matters is the difference between entry price and exit price. Think of it like booking a rate, not moving physical goods. You are trading a price exposure.
So if I understand correctly, if I go long, I'm saying I want exposure to a price rise. If I go short, I'm saying I want exposure to a price fall.
Yes, exactly. That is why both long and short are possible in futures. Simply put, long equal to buy first, profit if price rises, short equal to sell first, profit if price falls. So the biggest takeaway is this: in a futures market, you do not need to buy first in order to sell. A bullish trader can go long, a bearish trader can go short. Both are valid, both are normal, and both are essential for a futures market to function.
That was very insightful. Understanding this will now make it easier for me to take a position.
Summary. Let's recap. Underlying asset crude oil. Futures contract MCX crude oil March 2026. Contract size 100 barrels. Long position. Buy first, sell later, profit if price rises. Short position. Sell first, buy later, profit if price falls.
That means participants can benefit in rising as well as falling markets based on the position that they have taken.
Absolutely right.